Well, we are in the midst of wrapping up 2021 and also looking ahead to 2022. We're going to do the latter with our old friend Sam Rowe, editor of Ticker.co. And he has been looking at some of the big market themes to watch going ahead to 2022. Sam, welcome back. We want to look, first of all, as you did, at earnings, because earnings I think it's safe to say that a number of different metrics in 2021 were better than expected. We tend to see analysts sort of lowball these sorts of things, but nonetheless, earnings have been doing really, really well. So I guess one of the big questions that you're asking here is, will they continue to do as well?
Yeah, no, 2021, this whole pandemic period has just been really crazy in that everything has been very difficult to model. And that's what every single one of these analysts, and then you ask the strategists too, is all these models are so sensitive to all these different inputs that whatever it spits out, whether it's 10% earnings growth or 30% earnings growth, there's always this wide margin of error. Not to mention the fact that, so many of these inputs are, unpredictable. And I think one of the more interesting periods from 2021 was Q3, and even early Q4, where everyone was trying to understand the impact of the Delta wave of the coronavirus. And yes, there was an incredibly terrible variant of this virus, but people were out there shopping, and corporations were raising prices, and profit margins were getting fatter, and earnings crushed estimates yet again, as it often does. And so that's basically kind of the setup going into 2022, right? So 2021, based off of the estimates so far and all the data that we've already had, earnings are estimated to have grown 45% year over year since 2020. Now, 2020 has kind of a low base, but 45% is still pretty extraordinary. And going into 2022, all these strategists who are, forecasting where the stock market is headed, on average are forecasting about 9% earnings growth for next year. So, when you consider it relative to 45% growth in 2021, 9% seems kind of ambitious. But, when you consider the long history of the stock market and earnings growth, 9% ends up becoming, pretty average. So, the question ranges from everything to, is the bar set too high? Is it just right? Or, are we going to find out that, a lot of the things that we talked about last week, right? All these sort of signs of pent-up demand in the economy, is that going to translate to something that leads to even better earnings than what's currently being projected for 2022?
And Sam, I love me some gross profit margin calculations, but you, my friend, are looking at net profit margins next year.
Yeah, net profit margin, operating profit margin, gross profit margin, right? So, gross profit margin, Brian, that's sort of the starting point, right? Like what are costs going to look like? What are input costs going to look like for companies going into 2022? And, if it is the case that supply chains start to ease up and, actions from the Fed or whatever lead to a situation where input costs start to come down and, all these inflation metrics start to come down, then, gross margins could potentially expand. Not to mention the fact, and then if you go further down the income statement, I don't know how wonky we want to get here, but I like your setup, Brian. If we want to talk about, operating profit margins, so after all those input costs, you talk about all the various fixed costs that a business has, like, the leasing of office space or ongoing salaries for, the finance department or whatever. If there is going to be some sales growth, like we were talking about just before, if demand is going to continue to increase and sales is growing based off of a fixed cost structure, then yeah, you can get some more improvements in operating profit margin just because companies are producing more with their existing infrastructure. And But yeah, the forecast that you see in the chart, is net profit margin, and so that also incorporates things like interest costs, interest expenses, and taxes. And this sort of relates to the third item in the 2022 market themes. What happens with interest rates? Because of course, interest rates is something that's going to factor into things like interest expenses and interest costs. And yeah, it's going to have to do with what happens with interest rates in 2022. And I think we were talking. You guys were talking about this in an earlier segment. The forecasters out there are predicting long-term interest rates to rise. Like I think the 10-year yield is somewhere around 1.5% right now, but there's an expectation that that's going to start to grow to 2% and even potentially higher. So that's going to be an interesting one to watch because, of course, when interest rates rise, it's not just, the cost of borrowing for corporations, but it's the cost of borrowing for everybody. And that has a potential to ripple through the economy.
Although as one of the other charts that you have shows, stocks still traditionally have gone up after rate hikes. Finally, let's talk valuations for a sec, Sam, because this has been a perennial topic, right, for the past several years, where a lot of belly aching about high valuations, stocks priced to perfection, and then valuations just keep going up, or at least are elevated versus historical levels. So I guess that's one of the other lingering questions going into this year. Will this be the year finally that we see valuations start to come down in a more decided fashion?
Yeah, that's a great question. And this is the thing that's been driving investors and market forecasters, insane since, the beginning of the stock market. Like, I think Brian even mentioned, in the earlier segment that, one of the things that, he's learning is that valuations can stay very high for a very long period of time. And yeah, that's exactly what we're learning. It's not just this past year, it's the year before and the year prior that, these valuation levels have been elevated. If we want to start to get into the sort of the math of it all, there is this kind of irony that happens when, if valuations do stay this high for long enough, these elevated valuation levels end up becoming the long-term average that it's being measured against. But yeah, no, there's a lot of different sort of questions as to what happens here. Including, what happens to interest rates, because, there is this, this thinking that low interest rates is one of the reasons that valuations have been elevated because it justifies, a higher level of valuation for a number of reasons, including lower borrowing costs. But, when interest rates are really low, other kinds of securities that aren't stocks, that aren't equities, like bonds and credit and all these other more interest rate sensitive securities become a little bit more attractive because, you get more yield and suddenly, all right, well, it's a safer bet to invest in a bond that has a decent bond yield as opposed to a stock where you're trying to get a dividend payment, but, it's lower on the capital structure, all that good stuff. So yeah, it's a big question. It's something that's always, got people scratching their heads. But I think one thing that's really important to note, though, regardless of why whatever is driving valuations, it is possible for valuations, as measured by the PE ratios that we're talking about, it is possible for valuations to come down in a decided way without stocks going down, as long as earnings growth is outpacing stock prices, which is something that that happened in 2021. Remember, we started this segment talking about how earnings growth is up 45%, and this is a year where the stock market was up, about 30%. 30% is an extraordinary number, but 45% earnings growth is, actually a much higher pace of growth. And so this is why valuations have come down a little bit in 2021. So it's possible that we could get a repeat of that next year, where earnings growth outpaces stock price growth, and valuations come down as prices are rising.
Well, given what we're seeing in terms of some of the forecasts for the end of next year, it looks like that's what some people are banking on. Sam, good to see you. Thanks so much. Sam Rowe of Ticker.co. Thanks for being here. We'll talk to you soon, and Happy New Year. I know I saw more good swag there. It's a vest this time. Awesome. Thanks, Sam.